Hello everyone, welcome to the Ultimate Forex Trading Guide. In this video, you will learn everything you need to start trading Forex. So without any further ado, let's start. So let's begin with what is Forex. Before we start, a quick reminder. Listen, Forex can make you rich, but it is not a get rich quick scheme. You will need a lot of patience and practice to earn stable monthly earnings. I hope you all got that. So now let's begin. What is Forex? Simply said, it's a global financial market that allows one to trade currencies. You could earn if your prediction that one currency will be stronger than the other turns out to be accurate. The foreign exchange market, commonly referred to as foreign exchange or FX, is the largest financial market in the world. It is a decentralized market where the world's currencies trade. The market constantly changes because exchange rates fluctuates by seconds. Only a small percentage of currency transactions occur in the real economy, which includes foreign trade and tourists such as airports. Instead, the majority of currency transactions in the global foreign exchange market are bought and sold for speculative purpose. Currency traders buy currencies in the hope of later selling them at a better price. The FX market is open 24 hours a day, 5 days a week, closing only during weekends. The forex market does not close at the end of each business days like stocks and bond markets. Trading simply moves to various financial hubs across the world instead. So hope you all understood what FX is. Now let's see what is traded in forex. The simple answer is money, especially currencies. Forex trading might be confusing because you aren't purchasing anything real. So I will use a simple example for better understanding. Consider purchasing a currency to be similar to purchasing a stock in a specific country. The value of a currency is typically a direct reflection of a market view of current and future health of its respective economy. For example, when you buy the Japanese yen in forex trading, you are purchasing a share in the Japanese economy. You are hoping that the Japanese economy is performing well and will continue to improve over time. And once you sell those shares back to the market, hopefully you might make a profit. In general, the exchange rate of a currency against other currencies reflects the state of that country's economy in comparison to other economies. While there are technically thousands of currencies you can trade, as a beginning forex trader, you should probably start with the major currencies. They are referred as major currencies because they are most widely traded and represent some of the world's largest economy. But what forex traders consider to be major currencies differs. The self-writers who probably got straight A's and followed all the rules as kids only consider USD, EUR, JPY, GBP and CHF to be major currencies, and they identify AUD, NZD and CAD as commodity currencies. To keep things simple, we consider all 8 currencies to be the majors for us rebels. Currency symbols normally contain 3 letters. The first 2 letters identify the country's name, and the third letter, generally the first letter of the currency name, identifies the currency's name. These 3 letters are known as ISO 4217 currency codes. Take USD for example. US stands for United States and D stands for dollar. That makes it USD. Easy enough, right? So now that you got what Forex is, let's go a little further and learn some trading language. Let's start with pip and points. You have probably heard the terms pips, points, piplets and lots thrown around. And now I will explain what they are and how to calculate their values. This is where we will do a little math. Take your time with this information because it is extremely important for all forex traders. Do not even consider trading until you are comfortable with pip values and profit and loss calculation. A pip value is the unit of measurement used to express the change in the value between two currencies. If the EUR USD pair moves from 1.1050 to 1.1051, that 0.0001 USD increase in value equals to 1 pip. A pip is the last decimal of a price code. Most pairs are accurate to 4 decimal places, with the exception of Japanese yen pairs. They go out to 2 decimal places. For example, it is 0.0001 for EUR USD. and 0.01 for USD/JPY. Now, what is a pipit? There are forex brokers who quote currency pairs to 5 and 3 decimal places rather than the standard 4 and 2 decimal places. They are referring to fractional pips, also known as points or pippets. A point or pipet or a fractional pip is equal to a tenth of a pip. For example, if GBP USD move from 1.30542 to 1.30543, that 0.00001 USD increase is called 1 pipet. Now, what is a lot in Forex? Forex is commonly traded in lots, which are basically the number of currency units you will buy or sell. A lot is a unit of measurement for the amount of a transaction. When you place orders on your trading platform, they are placed in lot sizes. It's similar to an egg cartoon or egg box in British English. When purchasing eggs, you usually buy a cartoon or a box. One cartoon contains 12 eggs. The standard lot size is 100,000 units of currencies, but there are now mini, macro, and nano lot sizes of 10,000, 1,000, and 100 units. Some brokers display the quantity in lots, while others display the actual currency units. As you may know, the change in the value of one currency related to another is measured in pips, which is very small percentage of the value of a unit of currency. To profit from this minute change in value, you must trade large amounts of specific currency to see a significant profit or loss. Assume we will be using a standard lot size of 100,000 units. We will now recalculate some examples to see how the pip value changes. For example, the USD/JPY exchange rate is at 119.80. Now divide 0.01 to 119.80 and then multiply that to 100,000. Then you will get 8.34. Now that means 1 pip is equal to $8.34. Now the formula is slightly different when the US dollar is not quoted first. Suppose your USD is at 1.1930. Divide 0.0001 to 1.1930 and multiply it to 100,000. You will get 8.38. And now again multiply it to 1.1930. Then the final answer will be 9.99. That means you will get $9.99 for 1 pip. Your broker may use a different method for calculating pip values related to lot size, but they will able to tell you what the pip value is for the currency you are trading at the time. In other words, they will do all the maths for you. What is leverage? Leverage is basically borrowed capital. It is a sum of money provided by your broker in order for you to have more flexibility when trading on Forex. Because Forex lots can be extremely large, leverage allows you to trade larger lots and open more positions without putting all your equity into one large trade. An example will help you understand this better. Assume you choose the 1:100 trading leverage. This means that you will provide only 1% of the money while your broker provides the remaining 99%. If the trader does not use leverage, he or she will invest 1000 euros and benefit $5 or 0.5%. If the trader employs the 1:100 leverage and executes the same trade, their own investment is only 10 euros, but the profit remains $5, resulting in a 50% profit. Forex brokers provide a wide range of leverage sizes along with different leverage rules like 1:50, 1:100, 1:200, 1:500, even 1:1000, 1:2000, and 1:3000. You must select the leverage that is best suited to your abilities. So now, what is spread? For a currency pair, Forex brokers will quote you two prices, the bid and ask price. The bid is the price at which the base currency can be sold. The ask is the price at which the base currency can be bought. The spread is the difference between these two prices, also known as the bid-ask spread. The spread is how no commission brokers make their money. This spread is the cost of providing instant transaction processing. As a result, the terms transaction cost and bid-ask spread are frequently used interchangeably. Instead of charging a separate fee for each trade, the cost is integrated into the buy and sell prices of the currency pair you wish to trade. The spread is typically measured in pips, which is the smallest unit of a currency pair's price movement. 1 pip is equal to, like I said, 0.0001 for the majority of currency pairs. An example of a 2 pip spread for EUR USD would be 1.1051, 1.1053. Now, what types of spreads are in Forex? The spreads you will see on trading platform are determined by the forex broker and how they make money. Spreads are classified into two types. First, fixed, second, variable, also known as floating. Let's talk about fixed spread. Fixed spreads remain constant regardless of market conditions at any given time. This way, you know exactly how much you will pay for a trade. Another advantage is that the broker will be unable to increase the spread even if the market conditions change. Second, floating. Floating or variable spreads, on other hand, change all the time. They will widen or contract based on currency supply and demand as well as overall market volatility. Floating spreads typically rise during important economic releases and bank holidays when the amount of liquidity in the market decreases. Variable spreads eliminate records and can be significantly smaller than the standard when the market is calm. The best spread depends on your trading preference. So, what is a margin in Forex? Now that you know what leverage is, margin is easy. In Forex trading, margin is a sum of money that is required from you to open a position. The 10 euro the trader provides in case of using 1:100 leverage in the previous example is called margin. That means the funds in your trading account are the funds you use as margin when trading on Forex. Now, what is free margin? Free margin is the money that you have in your account that can be used to maintain your open positions or open new ones. To calculate free margin, subtract the margin of your open positions from your balance, which is your balance plus or minus any profit or loss from open positions. Now, what is margin level? The margin level is a percentage that shows the trader how much of their funds are currently not being used. If one of your open trade loses, your margin level will drop, and brokers will use the so-called margin call to avoid losing all of the money. Margin call is a specific margin level that, when reached by the trader, triggers an alert to ensure that the trader either close the losing trades or deposit more funds into the account. When the margin level falls to the minimum allowed level or stop out level, some trades, beginning with the most losing one, will be closed automatically to prevent the trader from going into negative balance. So now, what is equity? It is common for new traders to become confused between their balance and their equity while trading. While they may appear to be same amount at times, balance and equity refers to two different amounts. The amount of money a trader has in their trading account, for example their balance, plus or minus any profit or loss from open position is referred to as equity. If the trader has no open positions, his or her equity is equal to his or her balance. So I hope we are all clear till now. Let's take it a step further and explore even deeper into the Forex world. Now let's talk about types of Forex orders. An order is a request sent through your broker's trading platform to open or close a transaction if the instructions you provide are met. The term order basically refers to how you will enter or exit a trade. But be sure that you know which types of order your broker accepts. Different brokers accept different types of Forex orders. There are some basic order types that all brokers offer, like market order, an order that is instantly executed against a price set by your broker. For example, the bid price for EUR USD is currently 1.2140, while the ask price is 1.2142. If you want to buy EUR USD at market, it will be sold to you for 1.2142. When you click buy, your trading platform will immediately execute a buy order at that hopefully exact price. If you have ever shopped on Amazon, you have probably used their one-click ordering feature. If you like the current price, all you have to do is click once and it's yours. The only difference is that instead of purchasing a one direction CD, you are buying or selling one currency against another. Now second is pending order, an order that will be executed later at the price you specify, like limit order. A limit order is an order placed at a specific price to buy below the market or sell above the market. When the market reaches the limit price, this is an order to buy or sell. You can place a buy limit order to purchase at or below a predetermined price, or you can place a sell limit order to sell at or below a certain price. The order is triggered and executed at the limit price when the market reaches it. For example, EUR/USD is currently trading at 1.2050. You want to sell it when the price reaches 1.2070. You can either sit in front of your monitor and wait for it to reach 1.2070, or you can place a sell limit order at 1.2070. Then you could walk away from your computer to attend your cooking class. If the price reaches to 1.2070, your trading platform will execute a sell order at the best available price automatically. This type of entry order is used when you believe the price will reverse once it reaches the price you specified. A limit order to buy at a price lower than the current market price will be executed at the specified price or less. A limit order to sell at a price higher than the current market price will be executed at that price or higher. Now let's talk about stop entry order. A stop order prevents an order from being executed until the price reaches the stop price. A stop order is used when you want to buy only when the price rises to the stop price or sell only when the price falls to the stop price. A stop entry order is an order to buy above or sell below the market at a specific price. A buy stop order is placed to buy at a price higher than the market price, and it is triggered when the market price touches or passes through the buy stop price. For example, GBP/USD is currently trading at 1.5050 and is trending upwards. If the price reaches 1.5060, you believe it will continue in this direction. You can play this belief by doing one of the following. Sit in front of your computer and buy when the price reaches 1.5060, or place a stop entry order at 1.5060. Now let's talk about stop loss order. Stop loss order is an order to close out if the market price reaches a certain level, which could result in a loss or profit. A stop loss order is a type of order that is linked to a trade in order to prevent additional losses if the price moves against you. It is a sell stop order if you are in a long position. It is a buy stop order if you are in a short position. Note this kind of order. A stop loss order remains in effect until the position is liquidated or the order is cancelled. For example, you bought EUR/USD at 1.2230. You place a stop loss order at 1.2200 to limit your maximum loss. This means that if you were completely wrong and EUR/USD fell to 1.2200 instead of rising, your trading platform would automatically execute a sell order at the best available price of 1.2200 and close out your position for a 30 pip loss. Stop losses are extremely useful if you don't want to sit in front of your computer all day worrying that you will lose your entire investment. Simply place a stop loss order on any open positions to ensure you do not miss your violin classes. Please keep in mind that a stop order does not guarantee a specific execution price and may execute significantly away from its stop price in volatile markets. Stop orders can be triggered by sudden or possibly temporary price movements. If your stop order is triggered under these conditions, your trade may exit disadvantageous price. A sell stop loss order is more likely to be executed well below the stop price if it is triggered during a sharp price decline. A buy stop loss order is more likely to result in an execution well above the stop price if it is triggered during a sharp price increase. So now, what is trailing stop? Trailing stop is just like a stop loss order that is always attached to an open position and moves automatically when the profit equals or exceeds the level you specify. A trailing stop is a type of stop loss order that moves with the price of a trade. Assume you have decided to short USD JPY at 90.80 with a 20 pip trailing stop. This means that your initial stop loss was set at 91.00. If the price falls to 90.60, your trailing stop will be moved to 90.80 or break even. But keep in mind that your stop will stay at this new price level. If the market raises against you, it will not widen. Returning to the example with a trailing stop of 20 pips, if USD JPY reaches 90.40, your stop would be moved to 90.60 or lock in 20 pips profit. Your trade will remain open as long as the price does not move 20 pips against you. When the market price reaches your trailing stop price, a market order is sent to close your position at the best available price and your position is closed. Now let's see the difference. Limit order versus stop orders. Limit orders and stop orders are frequently confused by new traders because both specify a price. Both type of trades enable traders to inform their brokers of price at which they are willing to trade in the future. The distinction is found in the purpose of the specified price. When the market price reaches or passes a specified stop price, a stop order is activated. If the EUR/USD is trading at 1.1000, you have to buy stop entry order at 1.1010. Your order will be executed when the price reaches 1.1010. However, this does not necessarily imply that your buy order was fulfilled at 1.1010. If the market was moving quickly, you could have filed at 1.1011. Essentially, your order can be filled at a stop price, a price lower than the stop price, or a price higher than the stop price. It all depends on how much the market fluctuates when it reaches the stop price. Consider a stop price to be merely a threshold for your order to execute. The exact price at which your order will be filled is determined by market conditions. A limit order can only be executed if the price is equal to or greater than the limit price. If the EUR/USD is currently trading at 1.1000, you have a limit entry order to buy at 1.1009. Your order will not be fulfilled unless it is filled at 1.1009 or higher. Consider a limit price to be a price guarantee. Setting a limit order ensures that your order is only executed at the price you have specified. The catch is that the market price may never reach your limit price, resulting in your order being cancelled. Example, EUR/USD could only fall to 1.1009 before skyrocketing. So despite the fact that you wanted to go long EUR/USD, your order was never executed because you were attempting to enter a long position at a lower price. You sit back and watch EUR/USD raise without doing anything. This is the cost of using a limit order rather than a market order. So those were some of the most basic order types. Some brokers does allow some special orders, but let's talk about them in future videos. So now that you know what Forex is, why you should trade it, and who makes up the Forex market, it's about time you learn when you can trade. Yes, the Forex market is open 24 hours a day, but that doesn't mean it's always active throughout the day. You can make money trading when the market is rising. You can also make money when the market is falling. However, it will be extremely difficult to make money if the market does not move at all. That's why it's time to learn about the different Forex trading sections. Before we can look at the best times to trade, we need to understand what a 24 hours a day in Forex world looks like. A Forex market is divided into 4 major trading sections: Sydney session, Tokyo session, London session, and New York session. The Forex market has historically had 3 peak trading sessions. Rather than attempting to trade the market 24 hours a day, traders frequently concentrate on one of the 3 trading periods. This is known as the 3-session system in Forex. These sessions are the Asian, European, and North American sessions, also known as Tokyo, London, and New York sessions. Some traders prefer to differentiate sessions by continent names, while others prefer to use city names. The international date line is traditionally where the new calendar day begins, and because New Zealand is a major financial center, the forex markets open on Monday mornings while the rest of the world is still on Sunday. Even though the trading begins in New Zealand, it is still referred to as the Sydney session. There is no formally closed period during the week until Friday. There is a brief null in activity between about 19 to 22 GMT when most American traders have gone home and most Kiwi and Australian traders are getting ready for work. Apart from weekends, the only two public holidays when the entire forex market is closed are Christmas and New Year's Day. So by now you have learned some history about the forex and how it works, what affects the prices and much more. Now from here is where your journey as a forex trader begins. To begin, let's look at 5 ways on how you would analyze and develop ideas to trade the market. There are 5 types of market analysis: technical analysis, fundamental analysis, sentiment analysis, price action, and volume analysis. I will tell you about them in more details in my next video, so stay tuned and subscribe to my channel and press that bell icon.